Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Hope you'll check us out at jazzwealth.com, the 36th best advisor in all of America, according to USA Today. Thank you for that, by the way. We appreciate that. Apparently, they did a bunch of surveys and figured out, oh, we're 36th best out of like 22,500 and something advisors. Yeah, there's that many of them. If you're working with an advisor and they are not helping you with these kind of interesting data lessons and training along the way, I hope you'll consider us and move on over to Jazz Wealth. You can schedule a call. Actually, we don't have any sales pitch or anything, but let's get into it. Okay. So where is the market like right now? Right. This is a little bit of a departure from what we normally do, and I find it interesting. So I spend a lot of time on this. I want to spend a little time with you guys on this as well. Currently, the tech sector has the best rally over the short term here, 10.62%, with consumer discretionary right behind it. Remember that the tech sector and consumer discretionary are, that's your Amazon and your Alphabet. Netflix falls in there as well. Apple, Nvidia, that's those big names that weigh so much on the market. And we're going to cover that as well. Over the last 5 days, they're the best performers there. Year to date, they are not the best performers, right? Consumer staples, utilities, they are the only positive sectors year to date. Why is that? Well, when things get a little bit hairy out there, people get a little nervous, they tend to focus on the things that pay high dividends and have low volatility. That's your consumer staple stocks, the things that we'll buy anyways, your alcohol, tobacco, toiletries, and things like that. So that's understandable that these are the better types of plays here, whereas year to date, consumer discretionary and technology have the biggest pullbacks. Well, those are more aggressive. They're more volatile. We're betting on future earnings growth within these individual sectors. And right now with the tariffs and stuff, that looks a little scary. Now, we're going to go through some sector trends, and we'll go over that as well. Market breadth. Breadth is just a way of saying how much participation is there inside of a sector. Utilities has the strongest at the moment, which makes sense because utilities, what is that? That's safe, it's consistent, it's reliable. The most participation in that sector is happening because we're not sure if we want to take risk inside of the tech sector right now, so we totally get that. We'll touch on valuations here for a moment for all of you fundamental investors out there, and let's get moving forward. All right, over the last 5 days, we just mentioned this. Technology, consumer discretionary, communications services, that's going to include your Disney and things like that, have had outperformance relative to the S&P. Last 5 days, 7.18%. That's incredible, by the way. You just don't see the S&P consistently do that in 5 freaking days. So pretty impressive there. And on the downside, consumer staples losing a little bit of interest because money is starting to go back into that aggressive stance. People say, well, it's super discounted. I want to be a part of that. And that's what's happening there. Year to date, of course, consumer staples, utilities, just as a visual way of showing what's going on there on that first slide. Technology, consumer staples, still double digit discounted there in the short term. So if you're interested in that sort of thing, that's where you're focused. The S&P is also down 6%, at least as of now, right? Like today could be different, but it's where we stand there. So year to date performance, we are spread out. We do not have this consistent stock market moving in unison on the way up. So what does that tell you? Well, it tells you that you might expect a little bit of choppiness, right? It's totally normal. If we go a step further and we look inside of the various trends of the sectors there, I put a little chart together. What do we have? Well, what we did here is you have every sector. The current trend, technology is the only sector currently in a downtrend. We said, well, what is the timing of that? Meaning, if you were to be consistently adding to your portfolio, would you find that the timing is really bad because things are really expensive, or the timing is good because that things are cheap? So right now we still say, yeah, things are pretty cheap. You can go shopping out there and build little portfolios if you'd like, or add to the things that are discounted in the short term because they are quite discounted. We then decided to look through each sector and go, is it overbought or oversold, right? Standard deviations away from the 50-day moving average. Everything is currently neutral. And then speaking of the 50-day moving average, we said, well, what percentage of stocks inside of the S&P of the various sectors are above their 50-day moving average. Utilities ranks the best. 74% of all stocks inside of the utilities are above their 50-day moving average. The S&P 500, only about a third of the stocks. And that's because when you look inside, technology, only 30%. You got materials and real estate, about 30%. Financials beaten down here in the short term. Energy as well. And so you find that a lot of these stocks are still well below their 50-day moving average. And if you don't know, if you're brand new and you have no idea what this means, stocks being below their 50-day moving average are seen as a short-term discounted opportunity. I mean, I don't want to say they're going to go up, but if you had to, like, think of it this way. If you had to go buy a car, for me, I gave you $20,000, $50,000, whatever it is, go buy me a car. And all I want you to tell me is that over the last 50 days, you got me a better price than the average. That's all that is. People like to know that they got a better deal, whether it's a car, a house, or in this case, the stock market, right? So something to look at there. I know a lot of you are into the fundamentals there, so I wanted to include the trailing PE for each individual sector so you could see the technology is still almost at the top there. Industrials and real estate rank at the top as well. If you look towards the bottom, energy and financials. Remember a second ago, we pointed out financials discounted here, right? A little short term, got a little bit of a discount there, and year to date as well. If we look through the sector weights, why do we do this? This is important. If we look through the sector weights, this is the S&P broken down by what sector participates the most. I just did this in our Notes from Jazz email the other week. We said, look, technology is 30% of the entire S&P. So picture this. There's a day where, let me go back. There's a day where technology and financials don't do anything, right? That's essentially 45% of the entire S&P. Let's just call it half, right? Almost half. So if half of the S&P does nothing, and something like, where's energy? 3%. Energy has a 10% day. The S&P is still going to be pretty much flat. Why? Because technology and financials account for the bulk of the stock market. So when we go back, let me go back a few slides here. Ta-da. Over the last 5 days, technology being up 10%. Okay, why do you think the stock market was higher, right? It's because those tech stocks ended up giving us a little bit of a rally there, and that's what drives the market. So it's really important that you know that, okay, you could bet on real estate all you like, and utilities and consumer staples. Yes, it's slow and comfortable and pays a dividend and all that. But if they have a miraculous rally and technology does not, the S&P as a whole is not really going to go anywhere. And that's just the breakdown of the market cap weighted position of the S&P. Anyways, do me a favor down below. I wasn't sure I was going to do this video, but I kind of like talking about this stuff, like giving you the inside scoop as to how the market's going. Is it helpful? Like, should we continue with things like this, or would you rather go back to the planning and all that kind of geekery as we talk about it here? Hey, either way, I appreciate you watching. Thank you so much. I hope you'll subscribe to the channel. And most importantly, keep us in mind at jazzwealth.com. If your advisor is not keeping up with you and not talking about stuff like this, we do. Hope you check us out. See ya.